On the 31st of July, US Treasury Secretary Scott Bessent spent billions of America's money buying a foreign currency. But he wasn't spending dollars. A Reuters photographer caught Bessent's handwritten notepad at Camp David that morning, and the line on it read, quote, "To do, buy Japanese yen $5 to $10 billion. And Washington then sold tons of euros to fund that buy, alongside a Japanese operation of 8.45 trillion yen in a single day, the largest currency intervention in recorded history. Now, Washington doesn't just rescue foreign currencies out of the goodness of its heart. These actions are only taken because the alternative is more expensive. Japan holds $1.14 trillion of American government debt, more than any other country on the planet. And America just told the market that its funding depends on the solvency of a country that sits at 187% debt-to-GDP ratio with an export base that's dying by the day. So today, we break down why 30 years of Japanese money is finally coming home, why that's creating the most intense volatility since 2008, and what happens to global markets when the world's largest creditor stops lending. My name is Nick, and this is the Finance Bureau. Okay, it only makes sense to start this deep dive with the largest currency intervention in economic history. The yen had fallen to roughly 163.73 against the dollar in late July, a level not seen in about 40 years. Japan's Ministry of Finance went in hard, and this was the first joint US-Japan yen buying operation since 1998. The New York Fed sold euros rather than dollars, executed through primary dealers including Goldman Sachs and Morgan Stanley, using the Exchange Stabilization Fund so as not to drain dollar liquidity in the process. Bessent said afterwards, quote, "We will not hesitate to participate in further joint intervention." Trump called it a signal of friendship. Finance Minister Satsuki Katayama said Tokyo would not hesitate to do it again. And both governments went out of their way to advertise the Fed's FEMA repo facility, which lets Japan pledge its treasuries as collateral to raise dollars rather than selling them outright. Masahiko Liu at State Street said that the signal is bigger than the intervention itself. So we had some serious coordinated firepower with record numbers and a very clear promise of more. But there's just one problem. By the 7th of August, the yen was back to 157 to 158 versus the dollar, having handed back close to half the move inside a week. In other words, barely a week after the intervention, the market was already starting to call the US and Japan's bluff. Which brings us to what that intervention has really shown us, and global markets for that matter. Defending the yen costs reserves, and Japan's reserves are, overwhelmingly, American debt. So, Japan propping up its currency and dumping US Treasuries are functionally the same thing. Japan sold $47.7 billion of American Treasuries in March alone. Holdings fell by roughly $97 billion between February and May. And in May, by itself, Tokyo cut $66.7 billion, the largest single-month drop since September 2022, about 90% of its short-dated bills, which is what you liquidate when you really need dollars in a hurry. Across the first quarter, Japanese investors offloaded a net 4.67 trillion yen of US government, agency, and municipal bonds. And Bessent's actions didn't patch that vulnerability. Instead, he kind of published it. Every macro desk on the planet now knows that the marginal buyer of American debt is fiscally cornered. But the selling isn't only about currency defense. For 30 years, Japanese insurers and pension funds poured money into foreign assets because investments at home paid next to nothing. But that era is over. The 10-year Japanese government bond now yields 2.84%, a 29-year high, touching over 2.9% back in July. The 30-year sits at around 3.94%, and the Bank of Japan's policy rate is at 1%, the highest since 1995. For the sake of argument, and to set up the next part of this video, let's run the trade the way a Japanese life insurer actually runs it. The US 10-year pays about 4.65% against a domestic bond at 2.84%. That's 181 basis points of apparently free money. Except the American yield arrives in dollars and the insurer's liabilities, the pensions and policies it has to pay out, are in yen. So it has to hedge the currency, and the cost of that hedge is roughly the gap between the two central banks' short-term interest rates. With the Fed around 3.5% to 3.75% and the Bank of Japan at 1%, that hedge eats very nearly the entire spread. Run the numbers, and the hedged American bond now pays less than the bond available at home, with zero currency risk. For 30 years, money flowed out of Japan because the numbers made sense. Now, they don't. But it gets considerably worse, because the institutions that would normally absorb all that return in money are already deeply underwater. The four largest Japanese life insurers are now carrying 14 trillion yen in unrealized bond losses, up more than 60% from 8.5 trillion yen a year earlier. And Nippon Life accounts for 6.28 trillion of that, widening by another 554.2 billion yen in a single quarter, and in May it booked its first ever impairment on Japanese government bonds. Japan Post Insurance is sitting on 4.46 trillion yen of gross unrealized losses. Japan Post Bank reported 4.94 trillion yen in unrealized losses on its held-to-maturity bond portfolio for the quarter ending June, equivalent to 651% of its consolidated operating profit. And it's reaching these small institutions too, with Wakani Shinkin Bank issuing 20 billion yen of preferred stock just to plug the hole. These are the buyers of last resort, and they are nursing losses on the asset they're meant to be buying. But the other backstop is walking away as well. The Bank of Japan owns roughly 52% of all outstanding Japanese government bonds, and it is tapering by 200 billion yen per quarter toward a 2 trillion yen monthly floor by April 2027. And you can see that strain showing up in the markets. At the 30-year bond auction on the 6th of August, investor demand was noticeably weaker than at previous sales. But the 10-year auction 2 days earlier was worse. Demand fell to its weakest level since May 2025, and the government had to offer investors a much better price than expected to get the bonds sold. And that lukewarm reception could indicate that the intervention failed to turn sentiment around at all. And into that market, Prime Minister Takaichi is issuing 29.6 trillion yen of fresh debt inside a 122.3 trillion yen budget, where debt service has hit a record 31.3 trillion yen, up 10.8% in a year. She also, back in May, went and asked the Governor Ueda of the BOJ to buy more bonds to hold down the yields her own spending is generating. So we have a bit of a nasty loop of higher yields, higher debt service, more issuance, higher yields. And what's more, at 187.6% debt to GDP, Japan has very little room to get out of that cycle. Now, none of this would actually matter if Japan's exports were still refilling the savings pot like they did in the past. But things look very different nowadays. Now, China's sales fell 17% in the first half to 694,000 units, with global sales down 7.4%. Honda's China volume is running at roughly 650,000 units a year against 1.66 million in 2020, and it stopped production at the GAC plant in June. Consumer electronics went first, autos are going now, and Japan has no meaningful position in AI infrastructure, robotics at scale, commercial drones, or dominant EV platforms. Sony is down 13.5% over the past 12 months. So the country is burning down its savings while the industrial activity that built them is stalling. Now, keeping track of a story with this many moving parts is very tough, unless you have a team dedicated to doing it. And that's why you should sign up for the Finance Bureau newsletter. It's completely free, and we break down global markets along with everything else that moves your portfolio, so you never miss what actually matters. Just click the link in the description or scan this QR code on the left of your screen to get started. Right, back to Japan. Now, some of you that follow market price action closely might be eager to point one thing out. The Nikkei, which is Japan's primary stock index, is up 56% over 12 months, and that hardly looks like a country that's in trouble, right? Well, let's take a closer look. For starters, the index rose partly because the thing price in it collapsed. The yen is down 6.4% against the dollar over the year, and gold is up 29% in dollars over the year, and considerably more than that measured in yen because the yen gave way underneath it. And there's also the fact that the index is far from stable, falling 15% between the 25th of June and the 29th of July. And that tells you this is a market driven by emotions and leverage more than fundamentals. Now, to be fair, there is some reason for optimism when it comes to Japan. Japan's net international investment position is a record 561 trillion yen, which is roughly $3.5 trillion, which is why it's the world's largest creditor. Its $1.8 trillion government pension fund is also built to hold assets for decades, so it isn't under pressure to sell during market stress. New insurance rules also encourage companies to better match their long-term assets with their long-term obligations, which makes unrealized bond losses a bit less alarming. Morgan Stanley noted in August that investors are also relying less heavily on the yen for cheap funding, with some shifting toward the euro and the Swiss francs. And some argue that Japanese bonds are moving from uninvestable to investable, with a record 9.3 trillion yen flowing into 20 and 30-year paper in 2025 once yields broke 3.5%. And all of that may be true. But it doesn't change where this is heading, because when it comes down to it, for 30 years, ultra-cheap yen encouraged investors around the world to borrow in Japan and put that money to work elsewhere. If that trade starts unwinding properly, it spells trouble for everyone and everything. So just how big is the yen carry trade? Well, the number isn't entirely clear, but there are some reasonable estimates. Morgan Stanley has it at around $500 billion based on visible prime brokerage and futures positionings. The BIS, roughly $880 billion of cross-border yen claims, although the BIS's tiers run from $261 billion of direct bank borrowing all the way to $11.3 trillion once you include forwards and unhedged portfolio exposure. And then there's Deutsche Bank, sizing it at $20 trillion, or about 505% of Japan's entire GDP. Now, you might say, well, Nick, that's a massive spread in estimates. But that's much of the issue here. Nobody knows the size of this position, including the regulators, because it's in FX forwards, cross-currency basis swaps, and prime brokerage leverage. The BIS can see that the yen was borrowed, but it can't see what the yen bought. What it bought, as for anyone can trace, is Mexican peso, Brazilian real, Turkish lira, South African rand, and leveraged American mega-cap tech. Plus, there is also the retail leg, 9.4 trillion yen of Japanese household money pushed into foreign equities through the NISA scheme, on top of roughly 71 trillion yen of cumulative purchases across 28 million accounts by the end of 2025. And guys, we already know what happens when the funding cost moves, because we watched it happen 2 years ago. On the 31st of July 2024, the Bank of Japan raised its policy rate from between 0 and 0.1% to 0.25%. On the 2nd of August that year, a soft American payrolls print compressed the rate differential from the other side. On Monday, the 5th of August, the Nikkei fell 12.4%, the largest single-day point drop in history. The Topix fell 12%, and the VIX went above 65, which is 2008 and March 2020 territory. Korea's Kospi tripped circuit breakers and closed down 8.77%, and the S&P 500 lost around 6% across 3 sessions. The dollar fell from above 160 yen to mid-140s inside a week. And the crazy thing, guys, is that was just 25 basis points, just a quarter of a point from the lowest starting base in the developed world. And that's as clear as an example of market reflexivity as you'll ever get. The yen rises, margin calls land on yen-denominated liabilities, funds sell foreign assets to buy the yen, and those purchases push up the yen higher, and the next round of calls goes out. The unwind builds on itself. Nothing has to be wrong with the assets being sold, which is exactly why the selling is indiscriminate and correlations go to 1. Now, the 2024 instance stopped on the 7th of August when Deputy Governor Uchida publicly promised the bank would not raise rates while the markets were unstable, and the Nikkei rebounded 10% the following day. The central bank blinked in under a week. Now, let's compare the starting conditions that we have today. The policy rate is at 1%, 4 times that 2024 level. The BOJ is tapering rather than easing. 10-year yields are at 2.84%, and the yen is at just under 158 versus the dollar after an intervention that already burned 8.45 trillion yen. The trade that paid for 30 years paid because Japan charged nothing, but Japan now charges 1% overnight and 2.84% for 10 years. So, what actually happens from here? Which way does this break? Well, let's look at 3 broad paths. 1. The Bank of Japan steps in again to hold bond yields down, and that would put even more pressure on the yen, meaning more currency intervention, more treasury selling, and a weaker yen for longer. 2. Japanese insurers slowly bring their money home over several years, and that means less Japanese money flowing into foreign assets like Australian mortgages, French government bonds, and emerging market debt, pushing borrowing costs higher around the world. The US 30-year yield is already at 5.19%, up 33 basis points this year alone, and Japan defending its currency feeds directly into higher US borrowing costs. Not ideal for anyone, to say the least. And 3, the truly nasty version. Japanese 30-year yields break above 4.5%. Insurers are forced to start selling, and we get a repeat of the 2024 unwind, only this time without the promise of easier policy to calm the markets down. Whichever way this goes, guys, every single corporate refinancing and every mortgage on this planet is now being repriced by an allocation decision made in Tokyo by an insurance company nobody outside of Japan can name. Japan is the first developed nation to reach the end of debt monetization, and every other finance ministry is watching what the bond market does to it. With the market proving it can force Japan's hand, it's only a matter of time before that discipline gets applied to the next major country on the list. Now guys, Japan is far from the exception here. Countries worldwide are facing very similar problems. But the last time the world's largest creditor stopped lending, nobody had to guess what came next. And Bessent has shown the market where the vulnerability really lies. Well, that's all we have time for today, but what do you think? Is Japan a slow, manageable normalization that global markets will absorb over time, or is it about to trigger the next funding crisis? Let me know your thoughts in the comments down below. And if you want to understand who actually buys American debt if Japan keeps stepping back and what that does to treasury yields from here, then you can check out our video on that right over here. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, signing off.